Chat with Traders, episode 137.
This is your key to the minds of trading's elite performers, those who profit in relentless markets. Here on the Chat with Traders podcast, you'll hear about the skill sets and tactics that lead winning traders to win, so you can level up and become a better trader. Here's your host, Aaron Fifield.
What's up, crew? Welcome back. So last week I announced Chat with Traders merch is now available on the website, and of course it is still available. You can check it out at chatwithtraders.com/shop. But this week I have another announcement. This announcement is mostly relevant to my Australian listeners, and more specifically folks who are in Sydney, because on Tuesday, the 29th of August, I'll be doing a live podcast in Sydney at one of the WeWork locations. It's a really cool venue. This event will also double as a bit of a meetup, hangout type of thing, because I'll be putting on beers and pizza beforehand too. Now, the two traders who I'll be interviewing are Bryce Edwards and also Nick Fabrio. Nick, I apologize if I pronounce that incorrectly. These guys are both Australian equity traders and both very good at what they do. I can promise you that. For more info and to get a ticket, please visit chatwithtraders.com/Sydney. Tickets are dirt cheap. They're just $15. So again, chatwithtraders.com/Sydney. Now, on the podcast this week, I've got a very interesting character for you. The gentleman's name is Dr. William Ziemba. William is an academic, a practitioner, gambler, trader, and an author. He's worked with and consulted to many well-respected names in the field, such as Edward Thorp, Blair Hull, and the very successful horse bettor, Bill Bettor. In the beginning, horse betting was actually William's field of expertise. He even published a book titled Beat the Racetrack. And in many ways, for William, horse betting worked as a gateway to trading financial markets, which he's been doing since around 1983. In 2015, William won the futures division of trading competition Battle of the Quants. And now in current times, William manages a fund, Alpha Z Advisors, which has outperformed the S&P 500 by a long shot. The fund started in July 2013, and as of May 2017, it's returned 527%. Much of William's trading revolves around calendar anomalies, arbitrage strategies, and behavioral biases. We spend a good amount of time discussing these few things, plus William shares one anomaly he's been trading himself for many years. In the later part of this episode, we also talk about position sizing and the Criterion, and finally, we close things out with some discussion about horse racing. All right, so let's cut to the interview now. Just a final reminder, if you want to come along to the live podcast in Sydney, chatwithtraders.com/Sydney. Go there, grab yourself a ticket. Thanks very much for listening, guys. Please enjoy this episode.
Racing I've done for years and years, which is sort of how I learned the stuff I do in the stock market, basically. I think of it as like racing. The only thing is, the only difference, Aaron, is that in the stock market, futures market, you can stop the race when your horse is ahead. That's one of the differences. And the race ends. That's the other thing. In the financial markets, the race never ends. It's always going. So those are a couple of the differences.
Yeah, I mean, that's something I'd really like to get into with you, actually. But, I mean, just for starters, William, I know that you wear a lot of hats, or you certainly have done over your career. You know, you've been an academic, like we were just talking about sports.
I think of myself as an academic, and I do the trading as part of it. I learned from the books, and I paste them together. And when I talk to people, and maybe your audience, I have sort of 7 of them that each has certain ideas, and I sort of combine the ideas. And then I do the trading discretionary. You have to make fast decisions, and it's a judgment call. as to what to do. So that's there, and you have to be basically very careful and watch your risk control and not overbet. Overbetting is very tricky because you can be in a situation where you're not overbet and all of a sudden the market changes a little bit and then now all of a sudden you are overbet. So you have to adjust it. So and it's constant work. So you have to really pay attention. If you try to just do it fully computerized, there are people who do that successfully. But for me, I have to do it, with a lot of work. It's like a job. You have to work at it.
So how come that's the case? I mean, how come your trading isn't fully computerized?
Because you have to make fast decisions on things. Like, for example, in the Trump election, the market assumed that if Trump got elected, it's going to fall. And in fact, when he started winning, the market started out ahead. Then as he started winning, the market fell dramatically, 800 points on the Dow Jones. But there are two Trumps. There's the guy who fires people, who tells the French leader that his wife has a beautiful body, the guy who insults people, the guy who cheats people, doesn't pay his bills. There's that guy. Then there's a guy who calmly reads a speech written by somebody else and does it carefully. That guy, that Trump, is very bullish. So the minute that he, in fact, started the election speech after he had won, the first thing that came out of his mouth was not that Hillary is going to be locked up in jail and all this business. He said, Hillary's a great person. I really respect her. I knew the market had to fly. So you go along. So you have like 5 seconds or 10 seconds to decide what to do. So I don't know if your computer could really do that. You may be able to program it to do this thing, but I kind of doubt it. And I had to do the same thing in the French election. I had to do the same thing in the Brexit. And I feel fortunate that I won in all of them. And even in February 12, when the big decline of February of 2012 occurred, on the 12th, the VIX, volatility index, finally turned. So it turned lower. And then the S&P rallied, and one went monotone down, the VIX, and one went monotonely up, the S&P. So that was a good one. So you have to sort of, for me at least, have to make these fast decisions. So Ken Griffiths, the famous Chicago trader, he's good enough to buy $80 million Picassos. So things of that sort. His way of thinking is very similar to the way I think, which is you have to understand the theory, you read the stuff, and then in the end, it's a judgment call as to what to do and the size of the thing. And so you have to sort of know in advance how many positions to have and what kind, etc. Now, of course, Thorp and I and Len McLean did this book on the Kelly criteria. I've been doing papers on Kelly criteria for 30, 40 years. They go back to my 1975 book, Stochastic Optimization Models in Finance. And so they go back. So it's a long time. So you do that. But what I do is, after a while, you sort of get a feel for the size of the bets that you can make that are reasonable. So I do that. Of course, you can do calculations, and you can do them in advance, thinking about what's going to happen. So you just try to prepare yourself. But the thing is, you have to actually be ready. So when the event occurs, because it can go either way. In the French election, what was interesting was there were 10 candidates. 5 were for staying in, and 5 for what's called Frexit, which is French exiting. Now, of the 5, there was only one that's the top candidate. That's Marine Le Pen, who's a master debater. And so it was a threat. And of course, if she had won, that would have been very, very bad for the U.S. markets as well as the Europeans. But the minute that Macron won, and she won, because there was two that did the runoff, but the third place person went with Macron, that was my signal that, well, Le Pen's not going to win, therefore it's not going to crash, so the other option is it's going to rally. So I did that. In fact, that's the greatest day of trading I ever had in my life. We made 5% in the fund that night.
That is a good day. So these couple examples you gave, these were mostly around presidential elections. I mean, is that where the bulk of your trading is done? I mean, what about in between those?
No. I think that's one thing. I think what it is for 9 years, first of all, I went to Japan in at the time when they were essentially accumulating most of the world's money. So that was 87, 88, 89. In 87, we had a giant stock market crash in the United States. So when I got an invitation to interview to be the first Yamishi professor, Yamishi was the fourth biggest brokerage firm in Japan, sixth biggest in the world. Now, in Japan, stockbrokers are, in the status of the society, rated lower than garbage collectors. Kabuki dancers, potters, these are the people that are respected by people. So the economics departments have brilliant people trained at the top U.S. universities, as well as Cambridge and Oxford, et cetera, as well as the University of Tokyo. So in economics, it's very good. In math, it's very good. But there's nothing really in the business school and finance. So the brokerage firms wanted to kind of change this. So they gave a 5-year professorship to the University of Tsukuba, National University, to kind of develop that. And I interviewed to be the first one. And it was quite good because my wife got a very nice job. She's quite smart. And I was delighted that she got a job. And it's the same pay, men or women. It's based on age, basically, is the pay. And then my daughter was 9 years old and went to public school, red hair and all. And I had two things. I had teaching at the university, which was about 60 kilometers north of Tokyo. And I had nice classes, and people from the brokerage firm would come up, as well as people from the university. And then I had two projects. I had stock market anomalies, and I was one of the first to actually study that stuff in Japan. And then the other was crashes. And so I came up with a model based on the 87 crash for the crash part. And it worked very nice. And what we did is we made the model, which is basically stocks and bonds fighting for the money. So when bond prices are such that the interest rates are high, bonds get more of the money. And in the other case, when it's low, then the stocks get more of the money. So based on that, they had a crash measure, which explains the crash of 87. It also was, in fact, the basis of finding the model. So I had to find a place to test it out of sample. So I tested it out of sample with the past in Japan, because we're now in Japan. So I did 1948 to 88, 40 years of data. And it turned out the way the model works is you get a signal, and then usually the market continues to go a bit higher, and then it falls, and it falls 10% below the starting price. So that's so forth. So anyway, so in my recent book, which is in printing now on stock market crashes, we test that model against Bob Shiller's high PE and also by itself. So we discussed with that and so forth. So anyway, what happened was we tested it out of sample in Japan, and there were 12 times that the model went in the danger zone, and every time it fell, so no misses. And then at the end of 89, when you had the final push up, it was so far into the danger zone. So what I did is I sent the fellow who had worked with me, who had studied at Yale University for his master's, and also in Japan, and to talk to the executive to say that there's danger, they should do something. So what happened was they were the same people who had invited me for fugu, the fish, for golf, had taken us to dinner, had me give big lectures. But deep down, they really didn't believe that a foreign professor could understand their markets. Their markets were, in quotes, different. Well, in fact, they weren't different. The ideas that I knew from the U.S. study were basically the same. There's a turn-of-the-month effect. There's a monthly effect. There's holidays. There's all that sort of stuff. And in the book I did called Calendar, Anomalies, and Arbitrage, I have all the papers from Japan, and I do the U.S. case in Chapter 1, all the U.S. anomalies, which I use in trading a lot. So what I try to do with the books is everything in paperback so people can use the books. I don't care about the money. I just want people to use the stuff. And I use it myself. So that's the thing. So anyway, Yamishi wouldn't listen to Ishii and so forth, and told him, well, we like Professor Ziemba, but can he really understand our markets? Well, in fact, they made a huge mistake, because 5 years later, Yamishi was bankrupt, the entire firm, and a few years later after that, they ceased to exist. So that was an incredible call, but they didn't listen. So anyway, that's discussed a lot in this new book on stock market crashes.
Okay, well, you've mentioned a few things which I'd like to dig into a little further. I guess one of those being calendar anomalies. So, when you talk about calendar anomalies, and I know this takes up a large chunk of your trading, what are you actually referring to when you talk about a calendar anomaly? Like, what exactly is that?
Let me give you an example from Japan. In the United States, we found that two things. If you take the 70-year period, 70 years from around 1920 to about 2000, somewhere around there, you find that in the single month of January, the lowest decile stocks beat the highest decile stocks by 10.3% on average, year by year. And if you plot a graph, year by year, you find that almost every year the small caps outperform, and if they don't outperform, they underperform by just a little bit, etc. So the question is, how can you bet on this? So in '87, I did a paper that's reprinted in this Calendar Anomalies book, where you bet on that. And the idea was you go long a stock market index future, at the time called the value line, which was equally weighted, and then you short the S&P 500, which is value weighted, large cap. And you do this from about the period January 15th to about December 15th to about January 15th. Okay, so the effect was actually in January, but it's anticipated in the futures market earlier. Okay, so that I played, and I did that for many years, and I did it for 14 years, and I managed to win each year. But it changes a little bit each year, and you got to have confidence in it that's actually going to work. It's like a horse race, whereas I learned my trading from, and the thing is, the only difference is you can stop the horse race. So if you're ahead, you just say, I'm getting out, stop the race, I'm out, etc. So you can do that. So that was fine. That was a good one. Now in Japan, we go back to Japan. In Japan, I did the turn of the month effect. Now in the U.S., you had the following results. If you take the -1 day, that's the last trading day of the previous month, and the next 4 trading days of the next month, that is, on average, was getting about 2/3 of the gains of the whole month. And the rest of the gains were in the second week. And the third and fourth weeks are essentially giving you nothing. Okay, so you have -1 to +4. So I go to Japan, and it's a society that is supposedly male-dominated. So the salary man goes off to work, etc. The wife cooks and so forth and so forth. She's not allowed to go to dinner when the husband has guests, etc. However, one thing was interesting. The women have the unimportant jobs of deciding where the children go to school, where the money is invested, where they live, what kind of car they have, and things of this sort. And the men have the extremely important job of deciding what kind of sandwich they take to work. So once I discovered that the women control the money, then I said, well, when do the women get the money? It turns out they get it on the -5 day. And guess what? The brokerage firms know this. So they are sending people on the -5 day, knocking on the door, because the wife is there during the day, the salaryman's working. He's already given his check to the wife, and then she invests the money. So then the stock market turn of the month effect is -5 to +2, which is interesting. So you get the effect of behavior. So behavior is very important. So there's economics, and there's behavior, and there's flows of money, what I'll call institutional practices, etc. So that was interesting. So the women control the money. So that's clear, even more so than in lots of other countries. So it's so forth. So it's very interesting. Japan has a lot of different characteristics that are different than Western society. But very nice. We had a lovely time, the three of us there. And it was a nice time in our life. We really enjoyed it. And I wound up doing 3 books, of which you probably can buy them on Amazon for $3 if you want. One's called Invest Japan, which I thought was a good one, and one's called Power Japan, and one was a more academic kind of a book of collective works. So that was a turning point for me. I enjoyed it. I learned a lot. And if I just say one thing, Aaron, one thing I did, which was funny in the Anomalies, there was a guy called Mr. Okada who didn't speak English, and I didn't speak Japanese. I'm not good at languages. And we would sit facing each other with a translator, and we would talk for hours. And he would talk about the Japanese market. I would talk about the U.S. market. And we learned from each other. And it was very good to do that. And then when I was doing the books, I could relate to that. The books were basically done after the stay. I stayed with the family for 1 year, and then I consulted on a factor model of how to predict the best stocks to the worst in the Tokyo Stock Exchange. Basically, the way the model works is every month you get new data, and then you get things like earnings surprise, PE ratio, price to book, size of the stock, things of that sort. So I have 30 of these, and then basically you make the model, and then once a year we re-update it, and so forth. And what it does is it picks you the very best stocks each month, and then you rotate out of them the next month. So I could have a portfolio of the best 50, the best 100, etc. And it did work. And what happened was I published the book, and we don't get much as authors from the book. We get a little pleasure out of it. And a hedge fund called Buchanan in London bought a copy of the book out of the bookstore in London, and they discovered that I had a better model in the book than they were using. So I did consult with them for a few years after that, which was good because they used the model in a period when the Japanese market was falling versus estimated when it was going up. It just had minus signs in the coefficients.
Yeah, I would like to speak with you about some of the people who you have consulted with, because I know you've certainly worked with some really big names. But before we do that, supporting the podcast this week is Escastle Integration, a next-generation managed service provider focused on the financial sector. So for my listeners who are either running hedge funds, in the alternative investment industry, or in some capacity operating in the financial sector, please listen carefully, because for you lot, Escastle Integration can offer your firm access to the industry's smartest technology professionals, proven technology solutions, and a partner focused on making technology an enabler for you. Escastle Integration are trusted by 650 clients around the globe and have won many awards for doing what they do. In fact, this year, they won Waters Rankings Best Cybersecurity Provider and HedgeWeek's Best Global Cloud Provider. So speak with a representative today to learn more about how Escastle Integration can help with the technology powering your investment operations. Contact Escastle Integration at eci.com/traders. That's very simple, eci.com/traders. I just want to go back to that first example you gave when talking about the first example of stocks in January. Now, you said that you go long you're looking for the lowest decile and the highest, but how are you defining the lowest and the highest? Like,
lowest decile are the small sockets, Universal Widgets, such and such, and the highest decile are Microsoft, Apple Computer, these sort of things.
So you're looking at market cap?
Market cap, exactly. Market cap. We know at the moment, Apple is extremely high market cap, and Microsoft's had a very good year, a resurgence under the new president, and so forth. Now, you can't actually get the lowest decile. It's not traded as this thing. So the value line was equally weighted, which meant that Universal Widgets and Microsoft count the same. Now, so if they all count the same, then you have an emphasis toward the small stocks. Now, the reason that a monkey can beat the market by throwing darts at the newspaper is that it spreads it around and he gets more small caps, which on average, if you hold them, do better. Okay, they're a little bit more risky, but they generally have higher returns in terms of that. So that's one effect that's strong. Now, another effect that's strong is presidential elections.
Hold on, just before we move on to that, let me just ask you another question around this. So this particular trade of these stocks in January, the lowest decile outperforming the highest decile.
Buy the stock.
Yeah, no, I understand that. But that's kind of the premise or the theory for the strategy. So you're actually entering into a position in December and exiting in January. Do I understand that correctly?
Yes, you do. Now, the only thing, Aaron, that's very interesting is that in the beginning, we did this in 1983, 4, 5, 6, 7, when we did the first paper. And then later I did other papers. And they reprinted them all in this Calendar Anomalies book. But it moved because as traders and people look at this, first of all, when you study anomalies, it's a very hard sell. Very few people are willing to do it or interested as well. The people who've made a lot of money trading often do this, and they do sort of work, but you have to sort of believe in it in terms of the thing. Now, over time, the market changed a bit, and if you look at, and I have year by years in the in the book Calendar Anomalies. Every year is shown there. What happened was it moved in such a way that it got anticipated more and more. So nowadays, the entire January effect occurs in the month of December. It's not even in January anymore because it's moved forward. People anticipate that it's going to happen. So it's moved there. So if you do the trade these days, you do it somewhere around the middle of December, and you're basically out at the end of December. So then you're finished. And what's happened historically with me is I won the first 14 times, and then I taught it to Morgan Stanley, hoping to get consulting in New York. And it was a nice visit. I was paid well. It was a lot of fun. But the thing is, they had a lot more money than me. Morgan Stanley's a big outfit. And there was a fellow who had just joined, and he brought in 7 professors to give strategy ideas. I was one of them. So we did that. So I realized that the jig was up. I'm not going to be able to compete with these guys. They have more money, and there's more of them as well. But there was another thing. The volume was drying up. I was, as a professor part-time, I was 7% of the value line, which is really a lot to have. So then I stopped doing it for a bunch of years. And then Blair Hull, who you mentioned, gave me a consulting contract, and I studied anomalies in the U.S. with I have a fellow who helps me, Constantine. And so Constantine helped with the calculations, and I was doing calculations. And we've done some papers together. So I basically re-looked at all the different anomalies. So then I found that the Russell small cap had taken over for the value line, but it's value weighted. And because it's value weighted, the bigger stocks push it up. So it's essentially the 4th decile, not the 1st. But it did work pretty well in the simulations in the years I didn't do it. And then I started doing it with real money. And I did it 6 years, and I did win each year. And then I was 20 for 20. You're in Australia, by the way. I'm a student of undefeated horses. There's a horse in Australia called Black Caviar with 25 races, won them all. And we had a great female in the U.S. called Zenyatta. She was 19 for 19, but lost number 20. So anyway, I'm going for 21. And what happened was Yellen, who's the head of the Fed, she is, of course, instrumental in deciding the interest rates. They raised interest rates by a quarter point, which was not much in December 2015. But in December 2015, there was a lot of threat of many more increases, which did not occur. But that messed up the trade. So basically, we lost. It just didn't work. So anyway, it's a little sad to lose, but, not everything is perfect. And the other thing that's important is you cannot expect everything to be perfect. One of my good friends is a racing expert called Steve Roman, and he's a tremendous expert what's called dosage, which is the breeding of a horse. Can they win the races like the Kentucky Derby? And for a period from 1929 to the 90s, every single year, a horse that had too much speed and not enough stamina could not win the race. There's a score, and if you were above 4, the higher the number is, the more it's speed-oriented. And that's based on the parents. So what happened was Steve got a lot of bad publicity because people felt that this was infallible. And if he ever misses one, it's terrible. But the thing is, it's not terrible. I mean, if you get 9 out of 10, that's pretty good. If you get 9 out of 10 in baseball, you're the greatest hitter in the history of the world. 3 out of 10 is pretty good. So in any event, we have the same thing with anomalies. You win most of the time, but not quite all of the time. And the other thing is that if it doesn't quite materialize when it's supposed to, like many of the effects are that the small caps have bigger effects, they're longer, and they often move on the -3 day, the 3 days before the event. So if it does not occur, then there's trouble and the market often falls. So you get a sort of a signal in there that there's trouble in the market as well. So for me, I do the turn of the month, turn of the year, little stuff on holidays, presidential election effects, and so forth. And in the fund, which you mentioned, I do mispriced anomalies, and it's very similar biases to horse racing, extremely similar, and it's helpful in my thinking because I do both. And a mean reversion, prices go up and down and so forth. Huge mean reversion in NFL football, with prices going up and down.
Just before we get into the mean reversion stuff, that is something I would like to speak with you about. Just on the anomalies, you mentioned a little earlier that you'd done some research with Blair Hull and some consulting with him.
Yes.
I'd just be interested to hear a little bit about how you actually conduct your research for finding these anomalies. Like, can you just walk us through that process and sort of keep in mind that if someone at home is listening to this and they are thinking that they might want to try and see if they can find some sort of anomaly which they can exploit?
Well, first of all, you're coming from Australia, and we have the Australian stock market, we have the Canadian stock market, etc. Basically, what's the best is to postulate a theory of what you think will happen, and a lot of it has to do with how the money flows. What do institutions have to do? One of the reasons that the turn of month effect occurs is that at the beginning of the month, people are receiving money from their pay. So then they put it in the stock market, some of it. So it's around that period. So that sort of thing. So basically you sort of look at the data and just see what actually happened. And I like to dance around the issue, sort of think about it, talk to people. What are people doing? What are they betting on? Et cetera. So then you get sort of an idea of that. And then, of course, there is literature. There's a standard literature in the United States of January effect. There's a couple of Januaries. There's one that we mentioned of the small stocks outperforming. That's one thing. But there's a second one where the performance of January of all the stocks is a forecast as to what's going to happen the rest of the year. So you have the January forecast, and also you have the first 5 days of January forecast. So we have those. And that's called also in the trade January barometer in terms of that. And the result basically is if January is very positive, the rest of the year is usually more positive. If January is negative, the rest of the year is up or down about 50-50. And if it's wrong, then if your signal is good, it'll be less wrong. And if your signal is negative January and it's wrong, it'll be more wrong, if you understand that in terms of things. I have in the Calendar Anomalies book graphs of this sort of stuff.
From a few of the things I've read, which you've published and written about, and just from listening to you speak, it sounds as though you like to look at how things perform. So you're looking at things from when a signal occurs and then a number of days forward. Is that something you look at a lot? And not so much in terms of like trying to hit a price target as such. It's more about where does the market go end days after this event?
Aaron, I think you're on the right track there. It's not exactly a price target. It's where is it trying to go? And what's really good in trading is if you can be ahead of the game. So if you think it's going to go up, then you go more long. If you think it's going to go down, you hedge or go short. So try to get your thinking about that. And the other thing that's very important is corrective action and not overbetting. So if you're wrong, how fast can you correct it? So forth. So in terms of what I do in trading, constantly tinkering, it's moving a little, et cetera, et cetera. And it requires more work, but it does seem to work in terms of doing it.
Okay. And one of the things you said earlier, and I think your daughter, Rachel, may have actually said something along the same lines. I know she's very involved with, I think it's the fund. You said something along the lines, and so did she, anomalies are poorly understood and not used much. I mean, why is that the case, and how are they poorly understood?
If you take 100 people doing the stock market, there's only 3 who actually use anomalies, or very few. I think most people, especially those who go through MBA programs, even at the very best schools, are taught that the market is essentially an efficient market. You can't beat the market, and so forth. And the journals are controlled by people who live in a world where they believe that you can't beat the market. And it's unfortunate because over time they've had poor performance. But the thing is, they seem to have more of the money. They've accumulated more of the money, and they do. So the vast majority of the people actually don't do anomalies. Some people think they don't exist. I was at Princeton University recently, and the king of anomalies not existing is Burton Malkiel. He's made a fortune over a book that he's done on random walk down Wall Street. It's very good, but it's a certain extreme point of view. And I was pleased that I'm very aggressive in question period, and I had said a bunch of things, and he had done racing things, so he knew me. So he came up and bought me lunch, which I thought was nice. So he doesn't do the things that I do, but he at least appreciates it, and believes that we can in fact do it. And there's a lot of different camps in the stock market, different views that people have, et cetera. I try to write that up. One of the books is called Investing in the Modern Age, and that one we talk about what I call the 5 camps. There's efficient markets. There's risk premium. Efficient markets is the prices are correct except for transactions cost. Risk premium is you can make more money, but only if you take more risk. Then there's a category, efficient markets. Efficient markets are hogwash, and that's Warren Buffett's view that he'd like to endow chairs in efficient markets at all the top universities so he can beat them all, et cetera. And then there's the Paul Samuelson idea. Well, there are great traders out there, but it's hard to find them. For every 20 traders that you find that are there, only one's good. And then the last category are the people like myself who do research, look at things, postulate theories, do statistical tests of that sort.
Now, I cut you off earlier when you were starting to talk about your mean reversion trading, so I'd be interested to hear a little bit more about that. I mean, I know it's something you compare a lot to betting on the NFL. I mean, would you mind expanding on that type of thing?
Yeah, actually, if anyone's interested, there's 3 years of the NFL in the book Investing in the Modern Age, which is paperback. It's not expensive. And I do 3 years of it. And there's games in there that have the following characteristic. In the last 3 or 4 minutes, there's 4 lead changes. So they go up and down the field, and the prices are going up and down like a yo-yo. And so the way you do that is you have to have an account like Betfair in London, of something like that, where you can go long and short. And and then you watch it on TV and see it moves with the team's play. So there's one famous game I called the Game for the Ages, and that was San Francisco 49ers playing New Orleans with Drew Brees, the quarterback. And they were up and down the field 4 times in the last 3 minutes. Prices or so forth. Now, the stock market is not as violent with that. Now, my favorite teams, I have 2 favorite teams in football. I have the Seattle team, which is close to where I live in Vancouver, and then New England, which is where I grew up. Now, New England very often starts the game slow. So they're very often behind, but they're a very good team. They very often are behind the first quarter, maybe the first half, but by the third quarter they start rolling, and usually they win. They've got a phenomenal record, and I think it's just the way they do. So with them, you can do the strategies where you try to do an A/B trade. This is like what Thorp does a lot of this. This is sort of his stuff, which is you want to bet on A with certain odds, and then you want to get a bet on B at really good odds in such a way that A times B is greater than 1, and that gives you an arbitrage. In other words, you can't lose. It's a risk arbitrage because you put on A, you might not find B as well. So Thorp and I did one on Nick-Eye puts. Basically, I was the junior player, so I had to do most of the work at that time. And he was the senior player, and we had another fellow, Shaw from Gordon Capital in Toronto, who did this. And we had a good experience of looking at these Nick-Eye puts that were basically trading for too high a price. If you price them out with Block Scholes or something of that sort model, they're worth they cost a lot more. So we did that as well. It works out okay.
What you just described there, is that more of a spread trade than a mean reversion trade, though?
Well, spread is usually A minus B, and in mean reversion you can go long something that's behind, so it's just an A kind of thing, just one part. So I mean, there's a bit to what you're saying, of course, but I think the major idea is that the spread is like March versus June. Okay, that's a spread. Or small caps versus large caps. That's a spread. And the mean reversion is more like, well, the stock market is going down a lot, so I'll assume that it's going to bounce and go higher. So I just do one thing. I just go long the thing. So it's a little bit different with it's one thing versus 2 things, I think.
Okay, and what sort of mean reversion strategies are you using today, like in the Alpha Z fund? I mean, are these based on anomalies, or are these a sort of a different category of trades?
No, I think it's based on the way the prices are in relation to historical. So if you think you're in a trading range and it's not moving much, then as you get to the bottom part of the range, you could buy. You get to the top part of the range, you sell. Okay, so that's a standard thing you can do. It's not the most powerful technique, but it's useful on occasion. Usually what happens is you do it 3 or 4 times, and then the 5th time it goes one of the directions. So you have to account for that and make sure that in total you're ahead.
Now, William, I want to ask you, I kind of have to ask you a little bit about position sizing. You know, you and Edward Thorp and one other gentleman all co-authored a book on the Kelly Criterion. So how do you think about position sizing with your trades? Are you using Kelly Criterion? Are you using a fraction of it? I mean, how do you think about position sizing?
Yeah, I mean, this is a super important point. Now, when you get into trades, the easiest thing is entering. The hardest thing is exiting, how to get out. If you're very careful, you sort of have a plan for getting out, which you may or may not actually execute. Now, in terms of size, it's all related to the volatility. So it's VIX related in terms of that. Now, full Kelly has a lot of beautiful property. The long run growth is the highest almost surely over a long period. You're ahead in the first draw on average. You're ahead after so many. But you have one problem. The Aeroprat risk aversion index is minus the second derivative over the first derivative. That's essentially zero for log, which means that it's a very risky utility function with violent swings. So that's why often people will use fractional Kelly somewhere around a half. Half is the utility function minus 1 over W. Okay, so that's there. Now, with regard to the Kelly, you can have a hard and fast rule and can do calculations on the computer of how much to bet on different things. It's basically a nonlinear programming problem. It's not a one-dimensional problem. One dimension is the edge over the odds. But in multiple dimensions, you have to solve a nonlinear program. But you can judge the fraction that seems to work for you. We have a simulation paper comparing them. It's reprinted in this book, Great Investment Ideas, which I love. It's got a lot of nice papers. It's lovely. So it's reprinted in there. And what we did is we looked at quarter Kelly, eighth and three quarters, and so forth, all these numbers, and did compare, how it evolves over time. And that's good. A very typical good choice is half Kelly. It has a fairly good characteristic. Full Kelly is useful for cases like this. Horse racing, when you're making a lot of bets similar over time, essentially an infinite sequence of similar bets. Those high-frequency traders who are doing long trades of 8 seconds, like Renaissance Medallion, they are good for the Kelly. So that's the main case when you do. In horse racing, we use full Kelly because you're making a sequence of bets. They're all kind of similar. That's the idea. If you want a large sequence of bets and they're kind of similar, then it's pretty good. It's not guaranteed to give you the exact maximum, but usually it does most of the time. And that's the crux of the letters that Paul Samuelson wrote to me, which I was very flattered. He's the top economist of the last century. And he took an interest in that. He was always very friendly to me, absolutely brilliant guy. And the most brilliant person I believe I ever had dealings with is Kenneth Arrow, who also died. He died this year. And they were both around 95. They're both absolute giants. And I was pleased to know both of them personally, which was great, and so forth. And we've lived in a period, those of us who are a little bit older, of actually knowing a lot of these people who, contributed to the field. So.
I can't remember if your name was in it, but I know Ed Thorp and Claude Shannon and a few of those other guys from around from that era. There's a really good book, Fortune's Formula. I mean, I'm sure you're familiar with it, and it speaks about Kelly.
I did talk to him. We talked on the phone 3 times. He's a very good writer. It's a very good book, but he doesn't understand that when you have more than one asset, you have to solve the nonlinear program to get the proper weights. But other than that, he did a very nice job, etc. Now, because of that book, Motley Fool and Morningstar, they give Kelly weights, but they're incorrect. They say one stock and tell you how much weight to give into it, and they give you another stock how much weight, but you can't actually do them one by one. You have to do it together. But other than that, it's a wonderful story, and he did a good job. He's a very good writer, and he did talk to a lot of the major players in the subject. And I 3 times he called me up. We talked a bit.
That's William Poundstone you're referring to, right?
Yes, and it's another cheap paperback. What we try to do is for the people, like to read. My wife is a very good reader. Is have the books paperback, and they're not expensive, so people can get them. That's what I try to do with all the books for me.
Now, so is the Kelly Criterion, is that something you use to determine your position sizing today? Like that's something you're actually implementing? Yeah, but I'm doing it sort of in my head. See, I've been doing this for many years. I'm sort of approximating it how I feel it's going, because there's a lot of things going on. One example that Thorp found was there's a guy called Monish Parabek, and he had the following bet. With a small probability, you lose all the money. With a high probability, you double the money. And then with a medium probability, you more or less break even. So the question is, what's the optimal Kelly bet? Now, when you do the calculation, it's around 98% of your fortune. Because the way the Kelly works is, the more attractive the bet is, the more you bet. So you really pound it hard if it's good. Now the trouble with that is if you're wrong, you lose a lot. So that's why it's so violent if you do the path. That's why a lot of people like doing half Kelly. And what's half Kelly is half of the full Kelly, and then the rest is cash. So it's a toned down version. But you don't get the great long run growth, but you get a lot more security. And McLean and I have worked a lot on that, of these trade-offs between growth and security. It's just like mean variance, Harry Markowitz's trade-offs in mean variance analysis. Well, William, just for this last part, I'd like to speak with you a little bit about your experiences in horse racing. I think that'd be really interesting to hear a bit more about. You were, just so I get the order right, you were into horse racing prior to trading, weren't you? Like that's where you started out.
Yes, I grew up near Saratoga Racetrack, which is one of the major. It's a track of extreme tradition. And it was near where I grew up it's upstate New York. I grew up in the Berkshires section of Massachusetts. And I went and I started studying, and actually I started trying to do picking the best horse. But then I ran into Mark Rubenstein, who, he's portfolio insurance fame. And who I knew, and we started working together, and he pushed me in the direction of looking at it like a stock market. So then, and what happened was we worked together a little bit. He did co-author one of our papers, but Don Hosh and I basically did most of it. And he went on to do other things as well. Very smart guy, and so forth. But in any event, the idea that we did in the Beat the Racetrack book, some of the books are sort of out of print, but I keep redoing parts of them, like my new book, Adventures. I have a picture book with travel all around the world, and the publisher let me have color pictures of everything. And then I talk about all the consulting and working with a variety of very interesting people over time. But anyway, the idea of the place at show system is you get probabilities from the win market, and those are correct, except they're a little bit biased. So you're correct for the bias. And then you use those probabilities for a more complex market, place and show. So you do that. And then we've expanded that to all the other kind of bets. So you basically price the bets. And I have a book on that, but I haven't finished it. I've been doing it. It's hard to finish all the books as it is. I got 2 in print just recently. The Crashes book, which I love it. It's got great stuff. And this picture book, which is, I love it even more because it's got traveling in Afghanistan and Petra and Egypt and all sorts of places, which we were able to do as professors. It was nice. It was good. And so that was called Adventures of a Modern Renaissance Academic in Investing and Gambling. That's the official title. And the Crashes one I did with 2 other fellows. They helped me. One is in Reims, France, Reims, which is in the Champagne district with Sebastian Leo. And the other one is Mikhail. And Mikhail's in Moscow. And I ran into Mikhail when I was giving Kelly lectures, actually, at the University of Manchester in England. He's very smart. And what Mikhail and I were working on was, you think you have a bubble. Can you get out of the bubble at a good price and a good time? So we applied this to Apple Computer, to golf courses in Japan. By the way, I once gave a talk in your lovely Australia, and they said, "Why are you interested in golf courses?" And I said, "Well, it's a small market, but it's bigger than the Australian stock market." So that kind of calmed them down, etc. But anyway, the golf courses were incredible in Japan. It was a bigger crash than even the stock market. And then we did crash of 29, crash of 87, and this sort of thing. And it's quite nice. The model sort of ascends as the bubble starts forming, and then it tops off, and then it comes down. So we did that. And the other thing we do in the book that's interesting is how many crashes are there, and how many crashes do people expect? And it turns out they expect a lot more than actually occur. A lot of brokerage firms now are giving people trouble by saying, if you have a position and if it drops 20% tomorrow, you'd be in trouble, so you can't have so many positions, or 30%. And it turns out in the history of the United States, there's only one day where it fell over 20%, and there's only 3 days where it fell 10% or more, only 3 in 117 years. So the public expects more crashes than actually occur. That's the thing. So anyway, I'm very happy with those two things. I'm glad to be done on them. And then for me, I learn a lot from the books to just go on to the next project.
And while we're talking about horse racing, William, you've of course worked with one of the great names in horse racing, Bill Bettor. How did you come to meet Bill, and what was that experience like?
First of all, the teams that are professional teams, and I'm actually working now to develop our own with a group of people, and it's hard, and it's a lot of work, even with a lot of human capital. Now, Bettor came in. He's a former blackjack player. Many successful people in hedge funds and so forth came from a gambling background. So for me, I did horse racing. Thorp and Blair Hull and McPike, who's the guy I worked with in Nassau, and Bettor, they all came from blackjack training. And so did Bill Gross, the famous bond trader. What it does is it teaches you the risks better, and taking risks and dealing with them, et cetera, because the risk is super important. Now, Bettor started out, and he had trouble for a couple of years. He did talk to us a bunch on the phone, and we did. And he had new ideas that he did, and he worked hard at it, and it's paid off. He's a very wealthy man. And I didn't have a lot of contact recently. His only paper that he really published, we put in our book called Efficiency of Racetrack Betting Markets, and it became a sort of a cult item. Actually, some of the copies were selling for $20,000. I didn't sell them for $20,000. I sold one to somebody in Sydney for $1,400, which is the highest I got. But anyway, but then as an academic, we like to have it used by people. So we did a second edition, and it's $70 or something. It's from World Scientific as well. So in any event, Benter did a paper in there, and he discovered certain things and got it to work. Recently, he recommended me to be in a court case. So I'm representing a fellow who paid for a good model, and it was basically stolen by somebody else. And the somebody else claims that it's a different model, but we showed that it's actually the same. So that's still continuing, and these court cases seem to last forever. It's been going for about 4 years. So I'm doing that as a witness, and Benter was involved with that. And he, of course, made major contributions. He showed that you could take a sport like horse racing, where it's tough, and come from a different country and make it successful. So he did that. At the moment, there's about 8 or 10 teams around the world. The most important and successful one is actually in Australia, in Sydney.
Who's that?
It's Jelko.
Oh, okay.
He's a well-known guy. There are two of them. There's the fellow who wrote the programs. His name is Walsh. And apparently there's a huge museum that they built in Tasmania.
That's right, yeah.
From this, and he was very important in writing the programs. And I have met with him, and there's a lot of betting in Australia, very, very serious bettors, and rather good at it. So, he's a top team. And they bet a lot of money, and they win this consistently, and they're all over the world.
Do you think it's easier to make money in things such as horse racing or NFL compared to financial markets?
The stock markets are easier, definitely.
How come?
Well, the transactions costs are lowest. You trade a futures contract, and you do it, and you collect the $100,000 worth of money, and it costs you $10 to make the transaction. In the horse racing, you have to pay like 10 or 15%, even with the rebate. We have rebate now where you get some of the money back. So instead of having like a 15% commission transaction cost, it's more like 10 or 11 or 12. So it's lower, but it's still it's tougher. So these teams, to be successful, usually require about $1 million worth of research and a couple of years or longer to get going. So it's a major impact, and you need a lot of different things. And there's also competition because the different teams are competing against each other, making bets at the last minute. The racing is a lot of fun. It's a lot of fun, and the teams have been able to be successful and win, but it's work. It's harder, certainly harder.
Why are you talking about these people in terms of teams? Like, is it not possible for someone to do this as an individual? Does that make it even more difficult?
It's pretty hard as an individual because there's a lot of aspects. You have the computer program, you have the execution, you have collection of the data, you have watching the horses. There's lots of different features. Now, in Hong Kong, they have mostly Australian geldings. So it's a kind of a homogeneous group of the same horses running all the time. And the Hong Kong Jockey Club is very sophisticated and keeps a lot of records and a lot of information. Now, if you go to other places, like, for example, the United States, you have a race, say, at Belmont. It's a mile race. So horse number 1 is running 6 furlong races. He's now doing 1 mile. Horse number 2 is shipped from France and has never run on, say it's a grass race, never run on the grass. Horse number 3 is shipping from California and so forth, you know. So they're coming from different places and different things, and it's very hard to evaluate all of them. Like this year in the United States, in the Triple Crown races, the 3-year-olds, there's about 8 horses that would rate as B- quality. Nobody's an A or nobody's an A+. They're just, you know, any of the 8 could win any given race. And we saw that this week. We had a race called the Jim Dandy, and then we had a race called the Haskell. And horses that were not expected to win did win. So it's tricky. It's harder. It's certainly harder. It has a lot of charm to it, though, and there is a lot of computerized work. We have programs for all the bets, so we have that, and other people have them as well. You know, to calculate the sizing, as you mentioned, Kelly, and then also how to generate probabilities and things of that sort.
One of the things that strikes me is why it could possibly be easier to make money in sports betting or bet on horse races or whatever it may be compared to financial markets is, you know, the exact kind of payout and exact risk going into, you know, any bet. And I think you kind of mentioned this actually when we first started speaking. You know, financial markets are continually moving, whereas a race has a definitive start and finish point, and you know the exact payout odds. So I feel like the math for it would possibly be a bit easier to work out. But, I mean, is there any merit to that?
Well, yes. But so the way I'd sort of argue it, Aaron, is that in sports betting, you have a more sophisticated group of bettors. Like in the stock market, the vast majority are really not thinking about it, don't know much about it, and are just playing around. Okay. In sports betting, basically everybody who does it is pretty serious. So the quality of the competition is tougher in those things. But I mean, certain areas of the stock market, there's a high level of expertise, like, you know, different kinds of program trading or fast trading, this sort of thing. You mentioned other people like Blair Hull and these people. Some of them are doing very fast trading. I did talk with Jim Simons, who was the head of the Renaissance Medallion, which is the number one hedge fund ever. Phenomenal record. And for them, a long trade was 8 seconds, you know. So they're, you know, doing constantly fast trades. So that's where Kelly is actually very valuable to using that situation. But the rank and file in the stock market is not as sophisticated as the sports bettors. At least my opinion. No, somebody can argue against that, but that's what I think.
I mean, I always had the kind of assumption that it was much the other way around, because, you know, you hear about all these firms these days which are hiring PhDs and that sort of thing, and then I think about some of my mates who are betting on sports and just pretty much just throwing their money away. It's kind of silly.
Well, I have to tell you, in terms of that. See, for me, I got to be rated the number one futures trader in the U.S., and I am traveling around the world, giving lectures, giving trades on the phone. I'm not sitting in an office 24 hours a day at a computer with a computerized model as people are. But the thing is, Aaron, I taught part-time at Oxford for 9 years. Now, I was a fellow the first year, and then I taught after. The thing was that you had at Oxford is really smart kids. They're really smart, but they don't have much experience in the know-how of the markets. So I like to think that they're so smart they can lose money intelligently. These firms are filled with these kinds of guys, and these are very high quality kids. They're not kids; they're master students, but they're very talented, and some of them I'm sure are great traders, but on average, maybe not so much. So my experience is that people like to give the money to these big firms because it sounds like there's more sophisticated, but in fact, they have actually poorer records than even people like myself. But then I have to work harder at it, though. I work pretty hard to do it. I have people who help me. It's not just me. So they help me, et cetera. But I can do it, et cetera. But the thing is, I've actually written the books and studied them, in terms of understanding things. Whereas a lot of the people are just, they've been indoctrinated that you can't beat the market or something like that. And, it sort of hurts their performance. So just because it's a big firm with a big name, don't necessarily think that they're going to have top people running your portfolio. They may have top people running somebody's portfolio, but it may not be yours. So you have to be careful about that.
Yeah, that's a fair point. Actually, that's a good point.
Yeah,
and not to mention you're also a smart guy yourself, William.
Yeah.
So anyway, let's cut this off here. I know you've got to run in a minute. Absolute pleasure speaking with you. Thanks a lot for doing this.
Yeah, thank you very much. Nice to talk. Good luck with all your activities and so forth. So the only thing I'd recommend to people, or what I do, is study and then start doing it, but with small amounts of money, very small. You can do trading with a very small amount of money and get your feet wet and sort of thinking about things and study the books. And I mean, I have the books and so forth. There's about 6 or 7 for me. They'll be on Amazon or World Scientific Web, on their paper, and other people have things, and find things that you like that are useful and try it and get your own thing, and be very careful of not over betting. To always try to not over bet, because it's very easy to get in the situation where you have done it and all of a sudden the ratios change and you're over betting. Very good. Thanks, Aaron, for having me on. That sounds great.
Now, William, just one last thing. You have a website as well. If anyone wants to find your books, you mentioned they're on Amazon, but yeah, also on your website. It's
www.williamtziemba.com, my name. And that lists papers and books and talks and things of that sort. And I do the horse racing, which I like a lot, and then the stock market stuff and sports betting, etc. And I've been actually getting now into buying racehorses, which is part of it, which is another game that's very interesting.
Well, we might have to save that conversation for another day. But William, it's been an absolute pleasure speaking with you. Thank you very much for doing this.
Very good. Very good.
You've reached the end of this episode of Chat with Traders. But rest assured, there are more episodes loaded with real market insight and zero hype on the way soon. So to stay updated with each great new release, subscribe to the podcast in iTunes. And we'd love it if you'd leave a rating and review. We'll catch you next time on Chat with Traders.